Hello and welcome to today's webinar on qualified retirement plans presented by OJM Group. I am Jason Odell, a principal at OJM Group, and I certainly appreciate you taking time out of your busy schedule to hear our short webcast or podcast related to qualified retirement plans. Our purpose today is to give you a very brief overview of qualified retirement plans, the various types, and the importance of utilization of these tools, as well as other options. So I appreciate you taking the moment to speak or to listen to us, and let's get started. The first topic that we are going to look at is our disclaimer pages that are related to compliance issues that we have. I think one of the important items that we tell all of our clients and individuals that we work with, advisors, it's very important to make sure that you work with firms that have proper registration and licensing in their particular industry. For example, you wouldn't work with an attorney who didn't pass the bar or wasn't properly licensed to practice law in a state in which you reside. Same with CPAs. In the world of financial advising, the same is true. You want to make sure that the firms you work with are properly licensed. At OJM, being a multi-specialty firm, we do have various backgrounds of our team members, from lawyers to accountants to financial planners, investment professionals, insurance experts that work in a very coordinated manner. And over the years, we've been privileged to write a number of different books. We have a significant amount of content on our website that is accessible by you, and as a listener of this webinar, we are going to offer you at the end the ability to get a download of one of our books free, and I will share more of that with you as we get through the webinar. But this is a sampling of a number of books that we've written for the physician specialty as well as for the non-physician specialty, the business owner or executive. So we will get to that download code at the end. So to get into the context of our webinar today, retirement planning. What is a retirement plan? A retirement plan is what is typically meant when that word is said is it means some type of a qualified retirement plan. That means that the plan is qualified and meets the ERISA rules and regulations that are set forth and meets the Department of Labor's rules and regulations to allow some type of a retirement plan to be put in place by a company, corporation, that allows for its employees to defer income on a tax-favorable basis into this type of a plan. So when people talk about retirement plans, typically they're talking about qualified retirement plans. And there are many different types, and we'll talk about those types in a moment. We at OJM believe that the qualified retirement plan is one bucket in a multiple bucket strategy or plan for our clients. It's one place where our clients accumulate assets, but that there are multiple buckets that they should be accumulating assets in, just like other benefit plans or after-tax investments or real estate, any other asset classes or other places that you can accumulate wealth. The qualified retirement plan is a bucket. You have tax diversification in this bucket, which is key, as well as the other buckets are taxed differently, so that's where you get to have different types of tax treatment. What are qualified retirement plans as it relates to the ground rules? Well, you end up with two types, major types of qualified retirement plans. They are defined benefit plans and defined contribution plans. And we'll talk about the types of those in a slide here in a moment. You get excellent asset protection with these types of plans, federally exempt assets if it's a qualified retirement plan. So you have great asset protection. You have to cover all of your eligible employees, or if you are an employee and the plan is put out, you would be eligible to participate in the plan. You get a full deduction on the contributions that go in, and then when monies come out in the future, you're going to pay ordinary income tax on the distributions at whatever the tax rate is at the time you pull the money out. So the variable that you have here is you're deferring at today's tax rate, getting the tax deferral on the monies accumulating to then access those funds at retirement at ordinary income tax rates. The earliest you can access the money without a penalty is age 59 and a half. That is the earliest. You must start taking money out of your retirement, qualified retirement plan at age 70 and a half. So those are the two dates that you'll hear a lot about. Why 59 and a half and 70 and a half? Not really actually sure. Maybe a congressman or senator was that age at the time they passed this legislation and these rules. You have the potential, if you leave money in a qualified retirement plan and at death, there is the potential to have that money taxed up to 70%. Qualified retirement plan monies are going to be a death tax for ordinary income tax. They're also full amount in the plan is includable in your estate tax calculation. So as we tell clients, it's the worst place to die and have a lot of money sitting. So you'll want to make sure when you're thinking about taking distributions, this is a bucket you pull from earlier rather than later. Let's talk about the two types. You've got defined contribution plans. Now, the defined contribution plan, you're defining the contribution you're going to put away. These are the very much the more well-known types of plans like 401k plans and 403b plans. It allows for you to defer as an employee into a 401k plan $17,500 in 2014 and $18,000 going up to $18,000 in 2015. And so this allows those that are eligible to participate in the 401k plan to defer that out of their own income, not pay any tax on it. It sits in an account and gets invested. You also have profit-sharing plans that can be combined with this, which would allow that contribution to go from the 17.5 number up to the 52,000. In addition, if you're over 50 years of age, there is a catch-up provision that allows for additional contributions to go into both of these types of plans. In 2015, it'll be a $53,000 maximum contribution that will be allowed to go into the defined contribution plan. You've got flexibility on the funding, meaning you don't have to fund the full amounts, but you have flexibility. You don't have any penalties if you said, I want to put $7,000 in my 401k versus $17,500, and you can terminate the plan if you're the employer at any time, and there's no penalty for that. However, design of this plan is crucial if you're trying to maximize the benefit that the owner of a company would get. In order to do that, you need to have some provisions, typically the safe harbor provision, which is a matching contribution, must be put in place, and that matching contribution is given to all of the employees that would then allow an owner to get the maximum deferment to be put in the plan. So it's important to look at this designed when you're considering it. Defined benefit plans, which are the second type. So defined contribution we just talked about, more commonly known. Defined benefit plans, you're actually defining a benefit that you're going to receive in retirement. So this is actuarially derived. So you're coming up with a contribution that you're going to put in that is based on an actuarial formula that is meeting the retirement amount that you will need at some point in the future. These types of plans can actually allow for a lot higher amount of deferral, because if you're closer to retirement, if you're in your 50s and you're closer to retiring at 60, the age of the plan 62 or 64 or 65, it'll allow you to put a significantly larger contribution because you've got a shorter amount of time to get the amount put away to fund the retirement goal. This can be an expensive plan from the standpoint of administration, setup, and the contributions that would have to be made for employees. However, in today's tax environment, it does make some sense to consider these plans now. They have become more popular, and there are certain makeups of corporations that these types of plans can make sense for the owners to elect to put in place, assuming that actuarially the pricing can be done and it makes sense. You have issues related to underfunding these plans or terminating these plans. Monies that are put in this plan are pooled as it relates to investment management. And so the planning and design and an ongoing commitment to make these types of contributions is key when considering a defined benefit plan. However, as I mentioned, because of where we are with tax rates, and especially in the states that have high state income taxes, these plans are an excellent way to get a significant amount of money away in a very tax-favorable manner. You also have plans like a SEP-IRA out there. You have similar rules that are related to the defined contribution where you're able to put money away. You typically see a SEP plan with an individual that is receiving self-employment income, and this is a retirement plan. They can put money away. They're allowed to put away 25% or $52,000, whichever is less of their adjusted gross income into this plan. It goes up to $53,000 in 2015. You do have flexibility on the funding. The asset protection potentially may not be as strong because this type of a plan is governed or falls under state rules, not the federal exemption that qualified retirement plans are offered. Now, the big key with retirement plans are where are tax rates going in the future. And our qualified retirement plans, the deduction we're receiving today, is it a deduction that will allow for money to grow, and then when we pull it out, we'll be at a lower tax bracket, or tax rates will be down? This slide shows you the history of the tax code going back to the 1920s, and you can see we're at a relatively low period in the history of the tax code since the 20s, related to where we are today. We're relatively low. Now, to be fair, back in the 70s, with tax rates being higher, there was the ability to take larger deductions for items. But this is still a concern of ours, is where are tax rates headed in the future. The other concern is where will capital gains rates be in the future. So where are we today versus where have capital gains rates been historically? And you can see we have had a jump here, but we're still not back to the highs of what it used to be. So that's the concern. When I'm deferring money, do I defer it in a qualified plan, take a today's deduction to pay ordinary income tax in the future, or do I put money in other accounts where they would be after tax, but I would pay capital gains? There's no right answer. The answer is diversification. Use both buckets. Have multiple buckets working for you. Let's recap qualified retirement plans. Remember, get full deductions for the contributions. Money grows tax deferred, comes out at age 59.5 at earliest, taxed at ordinary income tax rates at that time. The value of the tax deferment is extremely important and is a significant aspect of qualified plans as well. Other things to consider when you're talking about retirement planning is what other vehicles are there out there. Up on the screen, you'll see a number of different buckets that you could use to put money into for retirement, whether that's a Roth IRA or non-qualified benefit plans or fringe benefit plans or even life insurance as a retirement plan. You've got other buckets that you can put money into, and back to the theme of tax diversification in many buckets, this is the reason why you want to have all these types of buckets in your overall retirement planning portfolio. Retirement plan structure, qualified retirement plan structure is essential and important. Definitely maximize the contributions that you put into your qualified retirement plan, especially if your company is making a match. Always, always hire a professional to assist you or your company in establishing these types of plans to make sure you're doing them properly. As I mentioned early on, I wanted to make this webinar brief, but offer you the opportunity to get a book for free on a download at our website. We are, as I mentioned, a unique firm. We're a fee-based consulting firm. We have over 1,000 clients in 48 states. We are multidisciplinary. We do comprehensive planning, both corporate and personal planning for our clients, and we have a firm commitment that any fee we would charge a client that qualifies and goes through our process, if we can't show a savings of 200% or greater in the fee we charge, we would return the fee to them. So we would encourage you to reach out to us at any time to schedule a free consultation. There's no obligation. We'd be happy to sit down and learn about you, your company, and see how we might be able to be a resource for you. Our bookstore is at www.ojmbookstore.com, and the code to use for a download would be WEB1114. That's WEB 1114. If you enter that access code, it would allow for you to download any of the books at the web store for free. And there's my contact information. I would certainly welcome to hear from any of you related to any questions you have on this or any other topics. Thank you again for your time. I appreciate it. Have a good day.